Hey guys, welcome back to the Capital Mindset Show. I'm your host, Austin, and today I kind of want to walk you guys through a trade that I made actually yesterday. I posted an article about it on our website, capitalmindset.org, and in this trade, I actually focused a lot of it around building my position more in Albertsons Companies, Inc., ticker symbol ACI. Now, there's a couple reasons that I did this, and as most of you might not know, or some of you probably do know, I'm rather new to the markets, actually. I'm actually an accountant that kind of came over to the investing side, and I only really started investing in July, to be completely honest with you. So I'm kind of drawing from my knowledge of accounting and more so putting that into investments right now. And so the reason why, what initially appealed to me about ACI was actually Fabio gave me the company. And it was when I was first kind of getting my feet wet in the water with investing, just kind of testing things out. And you can ask him. It's actually a really, really funny story. I was using a lot of different ratios about things that weren't exactly as important regarding the business, or I was Xing certain stocks because of criterion that Fabio then later explained is not necessarily indicative of the industry itself by which it relies in. And so what I found interesting about ACI was I was kind of applying that same level of practice, and I saw that the debt to equity ratio was quite high for ACI. And I was ready to X the investment there, but then I later learned that typically with grocery stores, there tends to be a lot of debt on their balance sheet. And then also too, if you see a high amount of payables, which I'll actually put up here, Albertsons balance sheet on the screen here. If you see a high amount of payables in the company, that's also the case too, because they finance a lot of their inventory, which their inventory for a grocery store is obviously groceries. They finance a lot of their inventory using credit. So that would make perfect sense why then the accounts payable number is typically high for businesses in this respective industry, and why it will always kind of remain high in and of itself as well. So back to the task at hand. I initially bought into Albertsons when it was about $23. I plugged it into the capital mindset discounted cash flow model. I initially bought Albertsons when it was about $23, and I assumed a 20% required rate of return. Typically, the way that I like to invest is I like to take 10% as my base, and then I increase my margin of safety from there. So I decided to assume a 100% margin of safety on top of the 10% base that I already had. Next to that too, I kind of did some digging. And I found that the grocery store industry as a whole is projected to grow between 2020. This was a study from last year, or it might have been from 2019. I'll link it in the description below. From 2019 or 2020 to 2027, the grocery store industry is expected to grow 5%. Now, basically, I don't like to put a ton of stock in what analysts say a lot of the times, which I'll do a separate video on later as to why I'm not exactly always trusting of analysts. But what's interesting is that this kind of corroborates here, which you can see here, what analysts are projecting the revenues will grow at. So basically kind of taking this, I also kind of extrapolated from there what the cash flows could potentially grow at over the next 10 years. And I decided on a 5% cash flow growth over the next 10 years. And that gave me a buy price back in that time period, not even assuming buybacks, that gave me a buy price of about $25. So back to the task at hand now. I kind of, first and foremost, kind of put Albertsons to the wayside. I bought in before it had that huge share run up, which I absolutely loved, but I kind of put it to the wayside, but then something kind of piqued my curiosity here. And that's something that I'll actually show you today. So here, this is a partnership that Albertsons and Google have actually formed together. And now what makes this really interesting, and a reason that kind of piqued my curiosity with this, is that they're planning on using data, and they're planning on adding these sorts of things called shoppable maps, customizing the grocery store shopping experience through AI. And then a third thing that's kind of really interesting to me, they're also planning on adding a system that can actually use predictive data and can actually build consumers' grocery lists for them. So now all of this was really, really interesting. And what's important to note about Google is that Google typically has a track record of trying a lot of different ventures, some of them succeeding and then others not doing so well. So basically the play here is to see if this partnership between Albertsons and Google can succeed into the future. Now that's what I'm kind of curious about. And the reason why I actually personally believe that it potentially can is because after the supply chain shortage ends, I'll put ends in quotations, but after the supply chain shortage subsides, we know that people are going to always need to buy groceries. Now, the other interesting part too is whether or not Albertsons can actually continue to expand across the country and then maybe even grow globally. So back to the task at hand and kind of taking a look here at the model now. Here was some of kind of the same assumptions. I lowered my margin of safety from 20 to 15. So now I have a 50% margin of safety. I did not lower my margin of safety, sorry, my required rate of return from 20 to 15%. And now my margin of safety is 50% greater than my required rate of return of 10% in the market. So I lowered that. And then I also decided to assume share buybacks because Albertsons are doing share buybacks, and they've also been increasing their dividend as well. So then I decided to take a 2% share buyback and then the same 5% growth rate in cash flows. Now, I actually believe that should the partnership between Albertsons and Google play out, I actually believe that these cash flows could grow greater over the next 10 years. However, whenever I like to invest, I like to typically take the most conservative measure my assumptions deem worthy, and then plug them there. Because if it's still a buy at the most conservative measure, which I believe is about 5% or even 3%, which is below what analysts are predicting next year's projected growth in revenues will be. But basically the point that I'm trying to make is that if the stock still returns a buy to me at a very, very conservative and low growth rate, then that also could mean that I would have a lot of upside potentially in my investment should my assumptions be proven to be correct. Now, my assumption is really leaning on the continual business excellence of Albertsons, which I do believe Albertsons is a good business. I believe it's a very good business, and I like the way management runs the business. If they can continue to see good business performance, and then also too, the partnership between Google and Albertsons, if that can play out correctly, I do believe the cash flows over the next 10 years will grow at a greater rate than 5%. But for the sake of this analysis, I decided to kind of take a look at this. And now let's kind of retrace for a second where the price was yesterday. The price was teetering around $28.90 to very low levels of $29 to et cetera, so forth. So I took a look at this model, saw that the price recommendation for me at Capital Mindset to buy was 36 roughly dollars. It was about 36 or $37. And then I decided to execute more so as a bet on that the partnership between Google and Albertsons would play out into the future and that Albertsons would continue to run their business quite well. So I really hope that you've kind of seen kind of some of my thinking in this, especially being a beginner in the market itself. Now, that doesn't mean that I'm a pure beginner where I don't know, like specific terms and specific jargon, because I am an accountant. It's just I haven't exactly brought that expertise over to the investment side. And I thought that it would be easy. I thought that I would be able to kind of come, and like start like knowing things and like, start to be able to make like plans and like really know how to pick, all these different stocks. But the thing that I realized, and the thing that I also kind of like my parting note here, is that it's a lot different. There's a lot of multi-layered facets that go into investing. It's a multi-layered cake. And that's really kind of the joy that I have with investing in and of itself. So I really hope that you've enjoyed what you've seen here today and you can kind of see my mind. If you have any pointers or any questions or any sorts of comments, please be sure to leave them in the comments below. We do, while our channel is still small, we do respond to any and all comments. Also, please be sure to visit our website at capitalmindset.org in case you have a stock that you would like me and Fabio to take a look at together. And then if you've really enjoyed this video, please share this video because it really helps out the channel. Please like, comment, and subscribe. I'm your host, Austin. This is the Capital Mindset Show. Take care.